Global financial markets are shaking in ways we have not seen for years. Gold and silver have experienced extreme volatility, and silver alone recently suffered its largest one-day decline since 1980, dropping more than 30% in a single session. That kind of move is enough to scare even experienced investors. It forces everyone to ask the same question. Do we sell and move on, or do we treat this pullback as the opportunity of a lifetime? This is not happening in isolation. Software stocks are collapsing under fears of artificial intelligence replacing entire industries. Bitcoin has lost nearly 50% of its value from its recent peak and still looks weak. Crypto markets are unraveling. Equity markets are unstable. Precious metals are swinging violently. This is not a normal market cycle. This is a period of global financial adjustment. History teaches us that moments like this do not mark the end of opportunity. They mark the beginning of it. Silver's collapse did not unfold over weeks or months. It happened in less than 2 days, and most of that damage occurred in just a few hours. Prices spiked lower and then rebounded quickly. Many people saw that drop and immediately concluded that the bull market was over. But that conclusion comes from fear, not from structure. When real market tops form, there is always visible damage on long-term momentum charts. In past cycles, in 1980 and again in 2011, there were clear structural breakdowns that warned investors in advance. Today, those breakdowns simply do not exist. Long-term momentum remains intact. There are no major trend lines being violated. There are no historical signals of a terminal top. This tells us something important. Silver did not end its bull market. Silver experienced a violent correction inside a much larger trend. Corrections do not destroy bull markets. They refresh them. What makes this even more significant is the timing. This correction came only 2 months into what appears to be a multi-quarter move higher. That is extremely early in the cycle. If silver had been rising for 6 or 7 months and had reached extreme levels before crashing, caution would be justified. But that is not what happened. This move began recently, and the pullback arrived early. That is usually how strong trends behave. They shake people out before continuing higher. Many investors compare this moment to the famous crash of 1980, but that comparison is misleading. In 1980, silver rose from $5 to $50 while remaining trapped inside a long-standing trading range. The collapse occurred at the very top of that range. Today's situation is fundamentally different. Silver has broken out of a 50-year price box. This is not a rally inside a range. This is a repricing event. When markets break free from multi-decade ranges, they rarely stop at modest gains. They often surge as prices adjust to a new reality. History shows this in other commodities. Copper traded in a narrow band for decades and then exploded higher within a few quarters. Lead followed the same pattern. Silver now appears to be doing the same thing. One of the strongest arguments for silver's upside is its relationship to gold. Last year, silver traded at barely 1% of gold's price. In past bull markets, that ratio was far higher. In 1980, silver reached more than 6.5% of gold's price. In 2011, it exceeded 3%. Recently, silver broke above 2% of gold's price, pushing through a long-standing technical ceiling. That breakout signals that silver is beginning to outperform gold after decades of underperformance. Even a return to the 2011 ratio would imply silver prices above $240. A return to the 1980 ratio would imply prices approaching $500. These numbers sound extreme only because people are anchored to old price levels. Markets are not anchored to comfort, they are anchored to mathematics. Gold itself still has unfinished business. It has had 2 major bull markets in modern history, and both delivered roughly 8-fold gains. The first ran from the late 1970s to 1980. The second ran from the early 2000s to 2011. Gold AS's most recent low was near 1,050 in 2015. Today, it is only about 5 times higher. If gold simply matches its previous bull market performance, it reaches roughly $8,500. If silver merely maintains historical ratios with gold, that puts silver in the $300 to $500 range. This is not speculation. It is historical precedent combined with arithmetic. Another powerful force behind this move is monetary degradation. Since 2020, money supply has expanded dramatically. In just 5 years, purchasing power has declined by more than 40%. Over a decade, currencies lose roughly 80% of their value. Gold and silver are not becoming more expensive. Money is becoming weaker. When silver's historical peaks are adjusted for today's money supply, fair value rises into the hundreds. That is not a prediction. That is math. Volatility frightens people, especially in silver. Gold moves 5% or 10% and people panic. Silver can move 30% in days. But volatility does not mean failure, it means revaluation. Over longer time horizons, measured in months and years, silver remains one of the strongest performing assets in the world. Even after this brutal pullback, silver has still outperformed gold over the past year. The difference between winners and losers in this market is not intelligence. It is timing. Those who chased at the highs feel pain. Those who waited now see opportunity. This is how bull markets transfer wealth from impatient hands to prepared ones. All right, let's switch gears and talk about cryptocurrency, because this story is a completely different animal compared to precious metals. For years, we heard the same old story. Bitcoin is digital gold. It's a safe store of value, a perfect hedge against shaky currencies. But what's been happening lately? Well, the reality is biting back. Bitcoin hit its peak, and then it just fell off a cliff, trading way, way below those highs. We actually saw this coming. There were specific structural breakdown points we identified months ago. Once those levels were breached, the price just collapsed. This wasn't some random fluke. It followed classic technical patterns that have signaled major downturns in the past. Sure, you might see some short-term bounces, a little bit of green here and there, but honestly, those are more likely to be opportunities for people to sell and get out, not the start of some glorious new bull market. And if you think Bitcoin had it bad, just look at Ethereum. It has performed even worse, tumbling all the way back to price levels we haven't seen in nearly 5 years. Think about that for a second. So many investors who jumped in during the hype of the last few years are now looking at massive portfolio crushing losses. This isn't just a healthy market correction, folks. This is the painful, loud pop of a speculative bubble deflating. Entire investment strategies, entire portfolios were built on this grand narrative that crypto was the new gold, that it would replace the old guard. Well, that story is now under some serious pressure. And the fallout doesn't just stop with crypto itself. This is where it gets really concerning. Many traditional, well-known companies have tied their financial health, their balance sheets, to these digital assets. Some even borrowed billions of dollars just to buy them. So what happens when the prices of those assets plummet? That financial stress starts to bleed out. It spreads beyond the crypto bubble and seeps into the broader corporate world. What started as a fascinating speculative experiment for a few is now becoming a genuine systemic risk for some major institutions. It's a domino effect, and we're just starting to see which dominoes are going to fall. But while all eyes are on the crypto crash, another major player is quietly waking up from a long slumber. I'm talking about crude oil. Remember that huge commodity rally from 2020 to 2022? Oil surged right along with it. But then, for the next 3 years, it got stuck. It was trapped in this depressed, boring price range. All that time, you had analyst after analyst coming out, predicting oil was doomed to fall to much lower levels. It's over, they said. But our momentum analysis just recently flashed a huge, long-term breakout signal. And historically, when we see this kind of signal, it leads the price. It doesn't just follow it. It's a predictor, not a reactor. The fascinating thing is, oil doesn't even need some major geopolitical event or a scary headline to start moving higher. The simple truth is, it's just incredibly undervalued. It's undervalued compared to its own history. It's undervalued compared to other assets. And it's especially undervalued when you consider how much our money has been devalued. Here's a really striking data point for you. If you look at the ratio of oil to silver, how much oil you can buy with an ounce of silver, it's at the lowest level ever recorded in history. Ever. Now, part of that is because silver has been so strong, but a big part of it is because oil has been so extremely weak for so long. The elastic band has been stretched to its limit, and it's not just oil. The entire commodity complex is stirring. A major momentum-based buy signal was triggered across the board last year, and since then, prices have been climbing, quietly, without any of the usual fanfare or media hype. Think about it. Commodities are historically cheap right now. They're cheap relative to stocks, they're cheap relative to gold, and they are definitely cheap relative to their own long-term averages. For years, we saw this strange divergence where gold was climbing steadily, but commodities were just stagnating, going nowhere. That relationship is now shifting. It looks like commodities are finally ready to join gold in a brand new cycle, pushing higher together. We're seeing improving momentum across the board, in copper, in base metals, in agriculture, and in energy. And I want to be very clear about this. These are not short-term trades. We're not talking about a quick flip for a few percentage points. This is a multi-year investment theme. It's about recognizing a major fundamental shift in the market, a turning of the tides that could define the next several years. It's a big picture move, and it's happening right now. The single most important development in the macro world is happening right now, and it's not where you might think. It's in the government bond market. For decades, bonds were the bedrock of finance, the safest asset you could possibly own. They were the foundation for everything: pension funds, bank balance sheets, even the reserves of entire nations. But now, that foundation is starting to crack. Why? Well, let's look at the money supply. It has absolutely exploded. In just the last 5 years, trillions of new dollars, euros, and yen have been created out of thin air. Every time a new unit of currency is printed, it dilutes the value of every other unit already in circulation. Your savings, your purchasing power, it's all being eroded. The bond markets are struggling to process this new reality. we're seeing some very strange behavior. Normally, when there's fear and uncertainty in the world, investors flock to the safety of government bonds. But that's not happening. Bond prices are staying weak. Even when logic says they should be rallying, this is a major red flag. It's so abnormal that central banks are being forced to step in, providing massive amounts of liquidity just to keep the markets from spiraling into disorder. But here's the catch. These interventions have consequences. Every time a central bank stabilizes the market, they're essentially creating more money. And all that new money has to go somewhere. This is a direct tailwind for precious metals. It's rocket fuel for gold prices and strengthens the already powerful case for silver. We're even seeing a major shift in thinking at the highest levels of finance. Big institutions are starting to openly admit that the classic 60-40 portfolio, 60% stocks, 40% bonds, is broken. Bonds are no longer the reliable hedge against stock market risk that they once were. So what are they turning to? Gold. It's increasingly being used as the new, reliable anchor in a portfolio. Even central banks, the ultimate insiders, are doing it. They're actively selling off their government bonds and buying physical gold at a record pace. This isn't just a minor adjustment. It's one of the most profound shifts in global finance we've seen in decades. Now, that's one part of the story. The other powerful opportunity lies in the companies that pull these metals out of the ground, mining stocks. For over 11 years, these stocks have been trapped in a deep, depressed valuation range. They've started to firm up recently, but they haven't had that decisive, explosive breakout yet. Think about the leverage here. If gold and silver prices continue their upward climb, the cash flow for these mining companies is going to go parabolic. Let's just imagine for a moment. If silver moves towards $300 an ounce and gold pushes towards $8,500, the earnings of these companies won't just double or triple. They will multiply many, many times over. This is exactly why, during major bull markets in precious metals, the mining stocks often dramatically outperform the physical metals themselves. So when we zoom out, the big picture becomes crystal clear. We are living through a historic, once-in-a-generation repricing of monetary metals and commodities. Silver has already broken out of a massive 50-year consolidation pattern. Gold is on track to match and likely exceed its performance from previous bull markets. At the same time, the old safe havens are crumbling. Government bonds are under immense pressure. And what about the new kid on the block? The narrative that cryptocurrency is digital gold is failing its first real test. In this new era, real, tangible assets are reasserting their timeless role. Real gold and real silver are reminding everyone why they have been the ultimate store of value for thousands of years. Now, I know some of you might be looking at the recent pullback in silver and feeling a little nervous, but I want you to reframe that. This isn't the end of the story, it's the entry point. This is the moment when fear starts to replace the recent confidence, and that's precisely when opportunity replaces complacency. Markets don't correct decades of mispricing and manipulation slowly and calmly. They do it violently. They surge, they overshoot, and they shock absolutely everyone. If a fundamental analysis suggests a price like $300 for silver is justified, history shows us that prices can blast far beyond that target before they eventually settle down. This is how financial history unfolds time and time again. The wave is forming right now. Those who understand what's happening will position themselves early. Those who wait for the all-clear signal for everything to feel comfortable and safe again will arrive late, buying at the top from the people who got in early. The future belongs to those who can see through the short-term noise and recognize that this isn't chaos. This is a transition. It's a seismic shift in the financial world, and it's an opportunity you won't want to miss. Thanks for watching, and be sure to subscribe for more updates as this incredible story unfolds.